Have you ever wondered why some incredibly brilliant people, doctors, engineers, executives, end up living paycheck to paycheck or be completely broke, while a modest janitor can die with an $8 million fortune? That's not a hypothetical question. This actually happened. Ronald Reed, a Vermont gas station attendant and janitor, left behind an $8 million estate when he passed away in 2014. Meanwhile, highly educated, well-paid professionals file for bankruptcy every single year. It's a paradox that defies standard logic. So what's going on? How does that math add up? Here's the thing, it doesn't. We are taught that finance is a math-based field. You put the numbers into a spreadsheet, you calculate the formulas, and you get the right answer. But the truth is, in the real world, people don't make financial decisions on a spreadsheet. They make them at the dinner table. They make them in meeting rooms fueled by ego, pride, marketing, and personal history. They're made in your gut, based on fears and experiences that go back decades. Welcome back to the channel. I'm Kenneth. When I work with business owners, franchisees, and investors, there is one indisputable fact I've learned from the trenches of finance. It's this: doing well with money has very little to do with how smart you are and everything to do with how you behave. Today we're doing a deep dive into one of the most important financial books of our generation, The Psychology of Money by Morgan Housel. Every chapter broken down, so you can understand the hidden psychological forces driving your bank account, and more importantly, how to master them. Grab a notepad. This is going to change how you look at wealth forever. The book opens with something that sounds almost too simple. No one is crazy. That's it. That's the whole idea. And I want you to sit with that for a second, because it's more radical than it sounds. If you grew up watching your parents lose everything during a recession, watching the lights get cut off, watching foreclosure notices show up at the door, you are going to have a fundamentally different relationship with risk than someone who graduated into a raging bull market and made money on their first investment. Same opportunity, same numbers on paper, completely different reactions. And here's what Housel says: both of them are rational. I see this play out in real life constantly. Two business owners, same industry, similar revenue, similar balance sheets. One takes on leverage aggressively. The other won't touch it with a 10-foot pole. You think one of them is being irrational, but they're not. They're both operating from the scars of their own experience, which leads directly into luck and risk. And this one I need you to really hear. We love to lionize the successful. We read biographies of billionaires and assume every single choice they made was a calculated stroke of genius. Every risk was calculated. Every move was intentional. But Housel says, slow down. Be careful who you praise. Be careful who you blame. Luck and risk are siblings, two sides of the exact same coin. Not all success is the result of skill and sacrifice, and not all failure is the result of laziness or bad decisions. Sometimes you make the right move, and the market destroys you anyway. Sometimes someone makes a reckless, irresponsible gamble and walks away a millionaire. So judge the process, not the outcome, because outcomes, especially in the short term, can lie straight to your face. Now, here's where the book gets darker. This next chapter might be the most uncomfortable thing in this entire book, and I say that having read it multiple times. It's called Never Enough. Housel tells the story of Rajat Gupta, former Goldman Sachs board member, one of the most powerful men on Wall Street, and Bernie Madoff. You know that name. Both of them had hundreds of millions of dollars, power, prestige, everything most people spend their whole lives chasing. And both of them ended up in federal prison. Why? Because they could not define what enough meant. They risked what they had, what they needed, for money they didn't have and didn't even need. Now, I want to be clear. This is not just a billionaire problem. I see this at every level. The business owner who built something genuinely worth $10 million, life-changing money, but can't stop, can't celebrate, can't be satisfied. So he makes reckless bets chasing $100 million and blows the whole thing up. The real estate developer who walks away from a profitable exit because he wants one more deal. One more. Always one more. Here's what I want you to understand. Beyond a certain point, the pursuit of more money is not ambition. It's just ego. Your expectations outpace your income, and you are never satisfied, no matter what the number on your account says. The goal is not infinite accumulation. The goal is to reach a level of wealth that buys you freedom, and then recognize when you've arrived. And that transitions perfectly into my absolute favorite chapter in this book, compounding. Now I know what you're thinking. Compounding. Yeah, I know what that is. Interest on interest. I've heard it before, but I promise you, you have not heard it like this. Here's the fact that stopped me cold the first time I read it. Warren Buffett's net worth is roughly $80 billion. And of that $80 billion, 97% of it came after his 65th birthday. Let that land. Not from genius stock picks, not from secret information, not from some special Wall Street access that you and I don't have. From time. He started investing at age 10, and he never stopped. Our brains literally cannot process exponential growth. For the first 10, 15, 20 years, it feels like nothing is happening. It's boring. It's invisible. And because we're bored, we make the worst possible move. We chase shortcuts, 30% returns, crypto moonshots, the next big thing. We blow up our positions, start over, and destroy the one thing that was actually building our wealth in the background: uninterrupted time in the market. Time in the market will always beat timing the market. A boring, reliable 8% compounding over 40 years doesn't sound exciting, but that is the strategy. That is the edge. Consistency, time, discipline. Now here's something that took me years to really internalize. And I mean years. Not from reading, from watching it happen to people I know. Getting wealthy and staying wealthy require opposite skill sets. Getting wealthy demands optimism, bold moves, calculated risk. You've got to be willing to be wrong and bet anyway. But staying wealthy, that's a completely different game. Staying wealthy requires humility, frugality, a healthy dose of paranoia. You have to look at what you've built and genuinely accept the market can take this back. The same aggressive, high-conviction mindset that gets you into the room where an 80-acre mixed-use deal gets structured. I've been in those rooms. That exact same mindset, applied at the wrong time, is what wipes people out. People who were this close to the finish line. You only need to get rich once. You have to stay rich forever. Survival is the strategy. And this idea connects directly to tails. You win, which sounds simple until you really think about what it means. In venture capital, the reality is brutal. Most investments fail completely. Gone. A handful break even, but 1 or 2 out of 100 become massive. And those 1 or 2 returns cover everything that failed, and then some. The same thing plays out in the stock market. A tiny, tiny percentage of companies generate the vast majority of all long-term market returns. Here's what that means for you. You can be wrong half the time and still win, as long as your wins are big enough to cover your losses. You don't need a perfect record. You need to stay in the game long enough for the tails to work for you. You're not trying to bat 1,000. You're trying to stay at the plate. What is the ultimate purpose of money? Not the house, not the car, not the watch. It's options. The highest dividend that wealth pays is the ability to control your time. To wake up on a Monday morning and decide, without asking anyone's permission, what you're going to do today. To say no to clients you don't respect. To say no to deals that don't align with your values. To have the freedom to wait for the right opportunity instead of chasing every opportunity out of desperation. Stop measuring your wealth by square footage and brand logos. Measure it by how much autonomy it buys you. If you're making $1 million a year, but you're a slave to a schedule you resent, you are not wealthy. You are well compensated. There is a massive difference, because time is the only resource you can never get back. Housel introduces this idea called the man in the car paradox. And the first time I read this, I genuinely laughed because it's so true. When you see someone rolling down the street in a $200,000 Ferrari, you don't look at the driver and think, wow, that person is impressive. You imagine yourself behind the wheel. You imagine how people would look at you. That's the trap. That's the illusion. We spend money on expensive things because we desperately want respect and admiration. But here's the thing. The people watching you are not thinking about you at all. They're using what you have as a reference point for their own desire to be admired. Nobody is thinking about you the way you think they are. If what you truly want is respect, and most of us do, then humility and genuine kindness will give you a far better return on that investment than horsepower ever will. And that sets up this next idea perfectly. Wealth is what you don't see. When someone passes by in a $100,000 car, the only thing you know for certain is that they have $100,000 less in liquid assets, or they're locked into a payment they resent every single month. That is not wealth. That is visible spending. Rich is income. It's visible. It's loud. You see the cars, the vacations on Instagram, the restaurant photos. But wealth is silent. Wealth is the portfolio growing quietly in the background. The cash reserves, the unexercised stock options, the financial assets that haven't been converted into something that depreciates the moment you drive it off the lot. The only way to be wealthy is to not spend the money that you have. Here's something that will genuinely reframe how you think about investing. Your savings rate matters more than your investment returns. We obsess over market performance. 8% or 12%. We track it like it's life or death. But your market returns, you cannot control those. Your savings rate, 100% in your control, right now, today. And here's the brutal truth about spending beyond your basic needs. It's not about lifestyle. It's not about comfort. It's ego. You are spending money to signal to other people what you earn. Live below your ego, not just below your means, and watch what happens to your savings rate. You don't need a market edge. You need a behavioral edge. And this leads into something Housel says that genuinely hit me. It is far better to be reasonable than to be completely rational. A mathematically perfect portfolio is worthless if it's so volatile that you panic and sell the moment things get hard. And they will get hard. They always do. A strategy you can actually stick to during the bad years is worth infinitely more than the optimal strategy you'll abandon under pressure. If keeping a larger cash cushion drags your returns down by 0.5%, but it means you sleep at night without anxiety, that is a winning trade. Sustainable behavior compounds. If there is one constant across all of human history, it's this. The things that have never happened before happen all the time. We look at the last 20 years and we build spreadsheets and models and projections. And then the Great Depression happens. And then 2008 happens. And then a global pandemic shuts down the entire world economy in 90 days. Every single one of those, massive outliers, events that the best forecasting models on the planet did not see coming. Do not assume the next 20 years will look like the last 20, which brings us straight to this. You need a margin of safety, because the future is unknowable, not just uncertain, genuinely unknowable. The most important feature of your financial plan is your room for error. Not room for things to go slightly wrong, room for things to go badly wrong. If your real estate portfolio or your investment strategy requires everything to go right in order for you to survive, you are not investing. You are gambling. And eventually, the house wins. Keep liquidity, diversify, kill the excess leverage. And say this out loud. The most important part of my plan is planning on my plan not going according to plan. Here's something I think is massively underrated, and almost nobody talks about it this directly: the sunk cost fallacy. We stay in careers we hate. We hold on to bad investments long past the point of reason. We stay committed to strategies that stopped working years ago. Why? Because of what we've already put in. The time, the money, the identity we've wrapped around a decision we made years ago. But here's the thing. You are going to change. The person you were at 20 and the person you are at 40, completely different values, completely different goals. The economy shifts. Life happens. Things you were certain about turn out to be wrong. Give yourself permission to let go of what your past self decided. Build flexibility into your finances so you are never held hostage by a younger, more naive version of yourself. And then there's this, an idea that genuinely changed how I think about market volatility. Housel says, nothing's free. Everything has a price. But in investing, the price is almost never obvious. If you want the historical returns of the stock market, the long-run average that has made more ordinary people wealthy than anything else in human history, the price is not the broker commission. The price is the emotional toll, the volatility, the crashes that feel like the world is ending, the nights where you check your portfolio and feel physically sick. Most people look at a market downturn as a fine, a punishment for doing something wrong. They panic, they sell, they lock in their losses and swear off investing. What if you looked at it as a fee instead? The cost of admission to the greatest wealth-building mechanism ever created by human civilization. You pay the fee in discomfort and anxiety and patience, and you earn the return. Once you accept that outsized rewards demand outsized discomfort, the ride becomes a lot easier to stomach. Here's something I'm going to be very direct about, because this mistake destroys people. One of the fastest ways to blow up your financial position is to take cues from someone who is playing a completely different game than you are and not realize it. A day trader does not care whether a company is fundamentally overvalued. They care about momentum over the next 3 hours. That's their game. Those are their rules. But if you are building a retirement portfolio, if you are a long-term buy and hold investor, and you take a hot tip from a day trader's Twitter feed, you are playing their game with your rules, and you will lose. Know your game, know your timeline, and do not get seduced by someone else's strategy just because it sounds exciting. Now, pessimism, and why it is so dangerously seductive. Ask yourself this: why does the person on financial television predicting total economic collapse always sound so much smarter than the person saying things are going to be fine? Because pessimism feels serious, protective. It sounds like wisdom. Optimism sounds like naivety, like someone trying to sell you something. But here's the reality. Progress compounds slowly. It builds over decades in ways that are almost impossible to notice day by day. Meanwhile, setbacks, recessions, crashes, crises happen fast and dominate every headline for months. Don't let the intellectual allure of pessimism talk you out of one of the most reliable forces in human history: the long-term upward trajectory of markets, innovation, and economic growth. And finally, this last idea. We all believe we know more than we actually do. Our brains hate uncertainty, so they do something incredibly dangerous. They fill in the gaps. They take the few data points we do have and construct a story, a narrative that feels complete, that feels certain. And when an investment opportunity comes along that promises incredible returns with zero risk, and we want it to be true, we will find a way to explain away the red flags. We will convince ourselves the story makes sense. Recognize that, name it, and accept this uncomfortable truth. There are forces at play in markets and economies that you do not and cannot fully understand, and neither can anyone else. The book closes with this: The Psychology of Money is not a finance book. It is a book about human nature. And human nature is the only variable in your financial life that you have any real control over. And then Housel does something I deeply respect. He tells you exactly what he does with his own money. And he admits it's not mathematically optimal. He owns his house outright. He holds more cash than most advisors would recommend. He invests in basic index funds, not because the models say that's the best strategy, because it gives him peace of mind. Because he can sleep at night, because a strategy you will actually stick with through chaos and crashes and uncertainty will always outperform the theoretically perfect strategy you'll abandon the moment things get hard. Every single time. Define what success means for you specifically, not for your neighbor, not for the person on Instagram, for you. Understand the price of that success, and commit to paying it consistently, patiently, without comparison. Master your ego. Respect the power of time and compounding, and put the control of your schedule above almost everything else. The math will take care of itself. I highly recommend picking up a copy of this book. If this breakdown added any value, hit the like button, subscribe, and drop a comment below telling me which idea hit closest to home. Keep building, stay disciplined, and you shall achieve financial abundance.